We talk about building a business that's scalable. I've talked about that many times, where you want to build something that can grow, that doesn't necessarily need you. That's the definition of scalability, that it can grow and it doesn't necessarily need you to grow. But if you want that business to be able to grow and not need you to grow, you have to do things that can't grow. The CEO of Airbnb and the founder of Airbnb talks about this very openly, where the thing that allowed Airbnb to grow to where it is today was doing things that are not scalable. See, now when you talk about giving somebody a review, you can give somebody a 1-star review, it was complete crap. You can give somebody a 3-star review, it was average. Or you can give somebody a 5-star review, which is, it was an amazing opportunity, a amazing purchase, great thing. And what the CEO of Airbnb talks about is an 11-star review process, where in his mind, especially in the early stages, he wanted to create the opportunity for customers to be so blown away by his product, doing things that are unscalable, that way his early customers would fall in love with his company and his product. That way, in the future, the unscalable things will allow the company to scale. Let me show you his 11-star chart. Hypothetically, a 1-star in Airbnb would mean that you got to your Airbnb, nobody is there, you knock on the door and nobody opens. Now you're very upset and angry because it seems like a scam. A 3-star review would mean you get to the Airbnb, they didn't open the door at first, you had to wait 20 minutes and then they finally let you in. You're a little bit upset, but you got the Airbnb, so it's okay. A 5-star review is you knock on the door, they open the door, the host lets you in, and everything is running just smoothly as you would expect. Things went just fine, but you're not going to go and rave to your friends about how amazing Airbnb was. You might just say that Airbnb was fine. A 6-star review in this instance would be you knock on the door, the host says, "Hey, I'm Reed, welcome to my house." And then they would show you around the house. On the table, there would be a welcome gift for you, a bottle of wine, maybe some candy. You open the fridge, there's some water. You go to the bathroom, there's toiletries there. They have just a bunch of things that you did not expect. They went above and beyond. That is a 6-star review, and now you're going to be much more likely to go out and tell your friends about it. A 7-star review is you'd go knock on the door, Reid Hoffman opens it, you get in and they say, "Welcome, here's my full kitchen. I know you like surfing. Here's a surfboard waiting for you. I book lessons for you. It's going to be an amazing experience. By the way, here's my car. You can use my car. There's this amazing restaurant in the city of San Francisco. You got a table there." And now you're like, whoa, that's way beyond what you expected. 7 stars. A 10-star review would be as soon as you get off the plane, there's 5,000 high school kids cheering your name with cards welcoming you to the country. You get to the front yard of your house and there's a press conference there for you, and it would just be a complete mind-blowing experience. And then of course, an even more over-the-top 11-star review would be you go to the airport and there's Elon Musk waiting for you saying, "We're going to space." That chart, by the way, is from a book called Masters of Scale. If you have not read that book, I recommend every entrepreneur go out and read that book. Now, what does this mean? Well, options number 10-star and 11-star are clearly a little bit too crazy and too expensive. You're never going to be able to ever make any money doing that. But what the CEO of Airbnb says is this is a good mental exercise to really play out what does an amazing experience look like and what does a completely over-the-top experience look like, and how can you create experiences, especially in the early days, which give your customers a 6-star, a 7-star, maybe an 8-star review. That way now your early customers are blown away by what you do. They go out and they tell all of their friends, they tell all their coworkers, they tell all of their family about the amazing experience they had with Airbnb, because that's what's going to allow you to build your loyal customers early on. Now, what does that mean? Well, financially, that means you might be losing money on some of these unscalable things because you're doing things that are not scaling. You can't go and keep spending money on every single customer and never make any money, but in the early stages, you want to make sure that your early customers are loving your product. You might have to spend more time talking to each one of your early customers to see what they like, what they don't like. Your time isn't scalable to do that. And when you're so focused on just making money, why in the world would you want to go out and spend money on something that's not going to give you a return? You already got the customer. Why go out and keep spending more money on them? Because if you want to build a business, you need to have that love. You need to have that trust. You have to go above and beyond to build that brand presence. That way other companies can't compete against you. Because when other companies are in it just for the money, well, they're going to not do the things that you do because you're willing to do things that don't scale. And sometimes when you want to build a scalable business, you got to do things that are not scalable. And that's the difference between building a business and just trying to make money and a lifestyle brand. And this is where now you got to figure out where along this trajectory do you want to be. You can work to build a business, but again, you got to have that entrepreneurial spirit where the purpose here is to build that value, to build that product, to change the world, to create something that is going to leave a legacy on the world. That is what an entrepreneur does. If you want to build a business, you have to have that mindset. Then you have the lifestyle brands, which is, I want to build a business that's going to fund my lifestyle and where I don't have to work too hard, where I just can kind of fund a decent lifestyle. I can have some nice things. Maybe I won't become super rich, but I'll have some nice things and hopefully I can have a decent lifestyle. In order to get there, you're going to have to put in a lot of work. But once you get there, then you can kind of coast and you know that you're never really going to be able to scale, and you have to accept that for yourself. Now, again, there's a lot of ways that you can do this. It doesn't just have to be a content creator. There's a lot of brands out there that are lifestyle businesses. A lot of mom and pop businesses are a kind of lifestyle businesses, but unfortunately, a lot of the mom and pop businesses are really not good lifestyle businesses because, well, if you go see what convenience stores owners or gas station owners, the lifestyle that a lot of them live, well, now you're working 7 days a week trying to run this lifestyle business. And so you got to understand now when it's a lifestyle business, sometimes a lifestyle isn't so glamorous. Now, if you get on the internet and you can build a big enough audience, sure, the lifestyle can be a lot better, but you got to understand the scalability that comes with that. And lifestyle businesses have their own kind of range of what work looks like the Kim Kardashian lifestyle business is 24 hours a day, 7 days a week, no holidays, because if she goes out of the house, someone's taking pictures of her, versus somebody who has 400,000 subscribers on YouTube. Well, you have a lot more flexibility and a lot more freedom, but you're also not going to make as much money as Kim Kardashian. Then you got the hustler who's just trying to make money. You can make a lot of money as a commission salesperson, especially if you're working in the financial services industry. But understand that you're not building a business. You're not getting any equity in the company. You're just getting a big paycheck. And this is where I do want to caution you that if this is something you want to do, fine. But don't get caught up into that commission salesperson lifestyle, which is you start making money and you start living bigger. You make more money, you drive a faster car. You make more money, you have a bigger home. I've seen this happen because I work with a lot of salespeople. I am a licensed real estate salesperson. I've worked with a lot of realtors. I've worked with a lot of mortgage brokers. I've worked with a lot of insurance salespeople, people who make great money. It's also cyclical. You're going to see booms and you're going to see busts. You're going to see booms in the housing market. You're going to see busts in the mortgage market. You're going to see booms in the insurance market. You're going to see busts in the insurance markets. And that's where use your money smartly. You can make a ton of money, but please put that money into assets. That way you can actually sustain and keep that wealth instead of doing what everybody else in that salesperson business, which is you live based off of what's happening in the economy. When the economy is booming, you're living big. When the economy is shrinking, well, so is your lifestyle. And this is where a little bit of smart financial planning can really go a long way. Now, going back to building a business. If you want to build a business, you're going to have to go through a lot of unrecognized crap. That's the reality of building a business. It has been glamorized a lot, but there's a lot of unrecognized crap where you're going to have to do things that don't necessarily make sense, and you're going to have to go through a lot of that crap in order to actually build that scale. And this is where it's going to be different for every industry, and you're going to have to find the right way to keep getting the reps in, to get your business heard, to get your business seen, to get the sales, and to grow. Like when I was trying to get exposure for Market Briefs and Briefs Media, which is my financial newsletter company, I initially started off by doing as many interviews as possible. Obviously, I talked about Market Briefs a lot here on my YouTube channel. Market Briefs is a free newsletter for investors where every day my team is breaking down what's happening in things like the housing market, the stock market, the economy, the global economy, and the crypto market. It's completely free, and you can read the newsletter in less than 5 minutes every morning. By the way, if you haven't joined yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But I would mention it a lot here on my channel. And that was when I had the idea, well, if I can mention it on my channel, how can I get my market briefs heard on other people's channels? And so that was when I started doing a lot of podcasts and a lot of interviews and collaborations with YouTubers. Now, I started working with whoever would accept me. If a YouTuber had 20,000 subscribers, I was doing the channel. I was doing the interview. If a YouTuber had 5,000 subscribers, I was still doing the interviews. And so now I went for a long period because I didn't have a lot of experience doing these types of collaborations, talking on other people's channels, doing these types of interviews where I was just doing pretty much whatever interview that I could get. And sometimes we would get like 7 new subscribers from the interview. And these interviews sometimes would take 30 minutes, 60 minutes, 90 minutes, plus the prep time and everything in between for me to go out instead of working on building my own channel, instead of going out and working to build a company, for me to go out and get exposure onto somebody else's brand. And sometimes we would see 7 new subscribers come in from all that time, effort, and work put in, not to mention the time trying to secure and get the interview and pay for people to get these types of interviews. But I did that, and eventually I started to get seen by some of the bigger podcasters. And then I got seen by like the Lewis Howes, the School of Greatness podcast. That interview did really well, which helped me get onto Tom Bilyeu's Impact Theory podcast. That interview did really well, and that helped get me onto Jay Shetty's podcast. And in each one of these, I got more exposure for market briefs because then I would go there, I would talk about financial education, I would talk about things that are important to me, and at some point in the interview, we would talk about market briefs, which helped give more exposure to market briefs and briefs media. So yeah, I had to put in a lot of reps and a lot of time trying to do things that didn't scale, but that allowed me to get more exposure later on. And so this is where now you got to find, where can you do the things? If you want to build a business, what can help you grow? If it is doing XYZ, if it's getting podcasts, you can't just go out and expect to get the big time podcast unless you can show that you can succeed on the smaller time podcasts. If you want to be a stand-up comedian, you're not going to end up at Comedy Central tomorrow. You got to show how you've done the work at the local stand-up comedy shows in your neighborhood, how you've done it in New York, how you've done it in LA, and then you can potentially get seen on Hollywood. Then maybe you get to be seen on Comedy Central. If you want to be an actor, it's the same thing. Get started on YouTube. Start putting out videos. Start creating sketches. The internet has made putting content out there so much more accessible. There's no reason why somebody who wants to be in the creative industry, an actor, a comic, a comedian, a film producer, cannot start creating content and get seen. Before, you had to go out and actually get gigs to be seen. Now you can start just creating your own content. And yeah, you're going to have to put in the work. If you want to build a YouTube channel, guess what? In the beginning, nobody is going to see your stuff. In the beginning of my YouTube channel, I used to send out a mass text to all of my friends, hey, new videos out. And then my videos would have like 117 views. The first 100 views were just mine because I just clicked the refresh button 100 times. And then it would be my wife, who wasn't my wife back then, and maybe my brother, and maybe a couple other people. And that was really it. And then I kept doing that. But then eventually I went from 117 views to 217 views. The first 100 were me. The next 17 were my wife, my brother, and a few of my friends. And then there was a new 100 people that started watching my videos. And then it went from 217 to 500 views, and then 1,000 views. And that's how it slowly started to grow. Now my YouTube channel has been seen over 150 million times, which is really mind-boggling to think that back in the day, I had to refresh 100 times on each video. I did that every time because I hated the idea of having a video with less than 3 digits of views. Like 12 views just seems so embarrassing. So I hit the refresh button again and again and again and again and again until I hit that 100. True story. But this is where you got to start somewhere, and you got to put in that hustle, and you got to be seen. And this is whether you want to be known as yourself, as a creative, or whether you want your business to be seen. It's the exact same process, because the name of the game is attention. You get customers because people heard about you, because people saw your brand, because people have seen your product. You can have the best product in the world, but if nobody knows about it, nobody's going to buy it. Your business needs that attention. It's the same with you. You could be the best comedian, the best actor, the best actress, the best educator out there, but if nobody's seen your content, nobody cares. This is where you need to now go out and get that attention for your business, or for you, or for your brand, whatever it might be. And that comes with the reps. And those reps are hard because most people get broke on the first 12 months of putting content out there, of doing things and constantly putting the work and not seeing any results. And that's a part of the game. My YouTube channel didn't really start getting any traction for the first 18 months. Now, 18 months, thinking about it in hindsight, doesn't seem like that long. Oh, a year and a half, that doesn't sound like that bad. Well, try going through that. Imagine putting out videos the first week, 3 times a week. And now you put out these 3 videos and you feel like, oh, I'm putting out the best videos ever. 3 videos in and you got 104 views on each video. And 100 of those are mine. Well, then you're like, well, let's see if next week is any better. Same thing. No additional views. Now you go the next week. Same thing. Nobody's watching your stuff. The next week, same thing. No one's watching your stuff. We're like, maybe I'll give it another month. Now, 4 or 5 more weeks go by. Still, nobody's watching. Then 6 months later, nobody's watching. And now people are like, dude, why are you still making videos? Why do you keep texting me about these videos and nobody's watching it? 9 months later, you keep texting your friends. Maybe you stop texting your friends. I'm pretty sure I stopped texting my friends like 3 or 4 months into it because they were all getting annoyed by my texts about new videos being out. 9 months into it, you keep doing the same thing. No one's watching. Maybe now 12 months and you're starting to see a little bit of traction, not much, but you're starting to see a little bit of traction and you're like, should I still keep spending all of my time doing this? And it goes back to now what's important to you. Are you doing something that can help your brand scale? Are you doing something that can help you scale? And you got to figure out what that thing is, because if you're just doing something that's not going to help you scale, that's not going to help you grow, that's not going to give you any upside potential, then maybe you should do something different. But if it has a lot of upside potential for you and it's something that you want to do and it's important for you or your brand, then you got to stick with it. And you got to keep putting out those reps, whether it's content, whether it's work, whether it's interviews, whether it's whatever. You got to keep getting the customers to see what it is that you have. And eventually, it might be another 2, 3, 4, 5, 6, 12, 18, 36, 48 months later, but eventually something will break. Listen to any great personal story, any great business. You got to put in the reps of doing a whole bunch of crap, getting nothing in return in order to be able to get to the point where you can get a disproportionate return for the little bit of work that you put out. And that's what building a business is about. There's a lot of similarities between building a YouTube channel and building a business. There's a lot of differences as well. But the similar part is you got to keep putting in the reps and not getting any results until you can start seeing results. And that is the difficult part, that if you're just in it to make the money, you're not going to be able to get through those reps. And even if you get through those reps, once you start making the money, then you're not going to want to do anything besides enjoy that money, which is going to then be the devastation of the business that you worked so hard to create in the first place. When I first started learning about entrepreneurship and I first started seeing success in entrepreneurship, this is years ago now, I was so obsessed and I was so excited because I finally, for the first time, started making decent money. And if you want to quantify decent money, it was probably $200,000 or $300,000 a year as an entrepreneur from my own entrepreneurial hustles. When I first started doing that, I was so excited because I felt like I finally proved the system wrong. Now, to give you a little bit of backstory, if you don't know, I did not go out and become a doctor, but my parents were not happy that I was not going to become a doctor. It created a lot of tension, a lot of controversy. So my parents and I kind of compromised, and I went to law school instead. But when I was in law school, I knew I wasn't going to be an attorney, so I worked on just my own stuff. And that was when I first started to really see my success as an entrepreneur while I was going to school, because I went to law school part-time, working on my businesses full-time, and I worked on a lot of businesses. I was working in real estate. I was a real estate salesperson. I worked in real estate wholesaling. I had an e-commerce business, and I was investing in real estate. So I was doing a lot of different things. But I started to see some success now as an entrepreneur, and I was so excited that I started telling all of my friends, you need to go out and become an entrepreneur, because there's this whole world of opportunity out there where you can earn more money the way that you want. Now, I didn't say that you're going to have more freedom, but I said that you can earn more money, and then you can take this money and invest it and be more aggressive with your investments. And I would pitch this so much that some of my friends got very annoyed by this. But a couple of my friends were really intrigued by this idea. And I actually got a couple of my friends, or one for sure, to quit his job. The other one kind of went part-time on his job, to quit their jobs and start working with me full-time. That way they can work on building their businesses. And that was when I learned the hard way that not everybody is meant to be an entrepreneur. Not everybody has the risk tolerance to be an entrepreneur. Not everybody has the discipline to be an entrepreneur. And not everybody is just built to be an entrepreneur. Period. That's okay. You don't have to be an entrepreneur. And, you know, this whole idea and world of entrepreneurship is so glorified now that, oh, it's so cool to be an entrepreneur. Yeah, so being an entrepreneur is hard. And it's not for everybody. It's not any cooler or better or grander to be an entrepreneur versus being an intrapreneur or being an employee. Okay, it does not matter what you do. If you are an entrepreneur, though, the way that you can build wealth is by working to build your business, build your income, take the money that you're making and invest it back into the business. And then eventually, as the business grows big enough, that's when you can take money out and invest it in things like stocks, real estate, and other places. If you are an employee or you're an entrepreneur working in somebody else's business, the way that you build long-term and real wealth now is you're working to get a paycheck. And now you take as much of this paycheck as possible. And you're going to take this money and you're going to put it into stocks. You're going to put it into real estate. You're going to put it into buying other businesses, because now you are working to build equity, not in your own business, because when you're working in somebody else's business, it's not your company, but you should still work there and treat it like your own company. That way you can continue to get raises. You can continue to make more money. But then you take the money that you're earning from this company that's not yours, and then you're going to build equity, not in that company, unless you're allowed to. Some companies will have that exception where you can build that equity in there. That's something you can consider if your company allows that, but most companies won't. But then you're going to want to work to build equity in other assets, real estate investments, rental properties, or stocks, or other businesses. See, when you're building your own company, now you're working to build equity in your own company. And the way that you can do that now is you're working to scale the brand, you're working to grow the brand, you're working to increase whatever it is that you're doing until now you want to either diversify or you no longer have a real growth potential in that business where now you can take the money and put it somewhere else. And this is where now, again, our economic system is designed to do one thing. It's designed to build an education system that produces employees. Now, why is this so important? Because we live in what's called a capitalist system. And in a capitalist system, there are two ways you can make money. You can make money from your labor, and you can make money from your capital. And guess what? In a capitalist system, which one is going to make you more wealth? Is it from your labor? Is it from your capital? It says it in its name, your capital. But what's interesting is our entire education system is designed to teach you how to make money from your labor. So we are taught to make money from our labor, right? You go to school, and if you do good in school, you're going to be able to go to a good college. If you go to a good college, the whole thinking is you're going to be able to get a good job. If you get a good job, you're going to make a big salary, which means you're making money from your labor. And this is why I keep saying it's not just how much money you make that matters, it's what you do with the money you make. You can make money from your labor, but the question is, what do you do with this money from your labor? Most of us never learn a thing about money when we're in school. I can tell you from experience. I went through high school, I went through college, I went through a year of grad school, and then I went through law school, and never once did I learn a thing about investing, building wealth, cash flow. I had to learn these things on my own. And so we learn how to earn from our labor. But in a capitalist system, the people who are the wealthiest, think of anybody, Mark Zuckerberg, Elon Musk, Donald Trump, it doesn't matter who you think of, and I'm not saying this from a political perspective, think of anybody who has money, Warren Buffett. What do? They own assets. If you want to win in this economic system, in this capitalist system, the way you win is by owning assets. Now, how can you own these assets? This is what the capitalist system is. You have to use your capital to own assets. You can use your labor, your job, to make money, use a piece of this money to go out and buy assets, stocks, real estate, businesses, whatever it might be. Or you can create that asset. That's being an entrepreneur. You can go out and build an asset. You can go out and create something that does not exist right now. And this is where the real wealth is built. If you really want to make money, that is what you have to put your focus on. If you are not an entrepreneur, that means you got to take your focus right now on not spending all your money, working to earn more money, and taking the difference between what you earn and what you spend and putting this money to work. Putting this money to work in the stock market, putting this money to work in rental properties, putting this money to work to buy businesses, putting this money to work by investing in startups, by investing in other businesses. That way now you have equity in these assets. That way now your money is working to earn you more money. Because when you go to work, you are working to earn money. But there's a limit to how much you can work. There's a limit to how much you can get paid. There's a limit to how many hours a day you can work. But there's no limit to how much your money can work. And this is where now it's, how do you scale what you can do? And there's a lot of similarities now between being an investor and being an entrepreneur, because I knew I wanted to be an entrepreneur from an early-ish age, even though I wasn't allowed to do that, but I knew that I had this like entrepreneurial bug. But what's interesting to me is as I went through my entrepreneurial journey, I went through a lot of different things. The first thing that I did was I was essentially a glorified party promoter. I was an event planner and doing parties and whatever. But what I learned was I didn't actually build a business, because the way it worked is I would go out and host a party. I was in college hosting college parties. I would go out and host a party and I would get paid. And I was making good money for a college kid. But I had essentially just created a job for myself, because the way it worked is I would have to go out and host a party. I'd have to plan it, be at the event, make sure that everything runs smoothly, and then I would get paid whatever money that we made. So I was creating my own income, but I really just created myself my own job, because if I wasn't working, I wasn't getting paid. And at the time, it was great because I was starting to finally make some money for myself. But then as I thought about what is a business, and I thought about the bigger businesses, I started reading more books, I realized that the biggest businesses and the bigger businesses out there, they create the ability for a person to pull themselves out of. That's real equity. Because if you think about what is equity, think about your home. If you own a home, if you bought a home for $500,000 and you built equity in this home, you paid off, let's just say $200,000. The home was worth $500,000. You paid off $200,000. So now you have $300,000 of debt, $200,000 worth of equity. What does the equity mean? The equity means you can do one of two things. Either you can do a cash out refinance, pull some of that $200,000 of equity in the home out through a loan, or you can sell the home for $500,000 and then get the $200,000 of equity in your pocket. That's real equity. When I was doing my event planning company, I didn't have any equity. I created a job for myself, but I had no equity in my labor. Because now if I wanted to sell that business, nobody was going to buy it. And I had no way to buy it because it relied on me to do something. And that's when I started thinking a little bit differently of how can I build something more scalable? How can I build something that's a little bit more of a real business as opposed to just me creating my own job? And that's a big difference between a solopreneur and a real entrepreneur, somebody who's building a real business that doesn't require them necessarily to be there for the business to continue living. And that's not saying you shouldn't work in your own business, but if you want to build a real business, there has to be an element of replaceability to you as well. Because if the business can't run without you, it's not a real business. If you're working a job, you're replaceable. If you died, or if you could not go into work tomorrow, the company is going to find a replacement for you in the next 4 weeks. And maybe you're really good at your company. Maybe you're really good and they don't want to let you go. That's good. That doesn't make you irreplaceable, because if you couldn't go into work tomorrow, they're going to have to find somebody to replace you. They might not be as good as you, but your equity in that company isn't going to keep paying your family if you stopped working there. Because you might build great rapport with the company. You might be very valuable to the company. There's nothing wrong with that. That's a good thing. But I'm talking about for your own personal finances. If you can't go into work anymore, your company's not going to keep paying you. Maybe you have a pension, but most companies don't offer pensions anymore. And so now where's your equity? And this is where now you are building your skill set. When you work at your company and you work up in the company, when you build your skill set and your knowledge and your ability to provide value, you can earn more for every dollar, for every hour that you provide. You earn more dollars for every hour that you provide. But if you stop going into work tomorrow, your paycheck's also going to stop. So again, where's that equity? What does equity mean? Equity means you can continue to keep getting paid without you having to continue going into work. And this is why the equity in your home is one of the worst kinds of equity, because the equity is essentially dead equity. It doesn't do anything unless you sell it. And so this is where, well, what are the alternatives? When you take your money and you go and put it into a stock, if you go put your money into the stock market, now you're building equity in this company, in this business that you're investing in on the stock market. If you were to invest in the Amazon Corporation, I'm not telling you what to invest in, just an example. If you were to invest in the Amazon Corporation, now, Amazon has a CEO that's working to drive up the profitability of Amazon. They're working to drive up the stock price of Amazon. And there are thousands of employees at Amazon that are working to make the Amazon company grow, to make more money, to produce the value that Amazon provides. When you buy one share of Amazon, you become one of the owners of Amazon. Just like that, when you go out and you invest in rental properties and you're building that equity in rental properties, now you're buying this land and this building, which is producing you cash flow. You have equity in this building that's producing you cash flow. Why? Because now there could be people living there. It could be an office that's using your building. It could be a restaurant that's operating at your building. It could be whatever type of building. Now, somebody is going to live in or use your property, and in exchange for them using your asset, your equity that you work to buy, you're going to get paid with cash flow. And if you do it correctly, the cash flow that you're getting, the rent that you're getting, should cover all of your property expenses and put some money in your pocket every single month. So now compare these equities. You can't go to work tomorrow because you got into a car accident. The company decides they're not going to keep paying you. What do? Well, if you have that sort of equity, you can keep getting paid. You can keep having your assets working to produce an income. If it's a rental property, they can pay you with cash flow. If it's dividend-paying stocks, they can still pay you dividends. Now, you might be thinking, but Jaspreet, it's going to take a lot of money and a lot of time for me to go out and actually own enough assets to produce a significant amount of cash flow. And you're right. It does take time. This is why I said, again, in the beginning of this video, it takes money to grow your money, but it doesn't take money to make money. If you want to make money, you need the hustle, you need the drive, you need the work ethic, and you need the ability to take risks, and you need the ability to learn. If you can do those things, you can go out and earn money. But if you want to grow your money, now you need more money. And this is what your equity is doing. When you're trying to create or buy this equity, now you're working to grow your money. And this is where the real wealth is built. It's about buying more stocks, buying more real estate, investing in other businesses, investing in other things that are paying you. Now, there's different ways that you can get paid. You can get paid with cash flow, or you can buy investments that go up in value, or that you're buying for the purposes of going up in value. I like cash flow. That's just the way that I am. I like buying an asset and knowing that I'm going to get paid month after month after month, or quarter after quarter after quarter, because now what I'm doing is I'm just working to stack the cash flow. I'm just trying to buy more of these cash flow producing assets that every month I'm getting paid more cash flow, more cash flow, more cash flow, because that's the way my mind works. Other people don't like that because the cash flow gets taxed. If a company is paying you with dividends, that means the company is sucking money out of their bank account, and instead of trying to grow the company bigger and faster, they're paying their shareholders. So some people don't like that. Other people say, you know what, I like a company when they take the cash and they reinvest it back into the company. That way they can't pay me a dividend, but that's going to make the company grow bigger. It's going to make the company grow faster, so the stock price grows faster. Some people like that. Plus, if you're not getting paid with cash flow, you don't got to worry about paying taxes, because when you get rental income or when you get dividend income, that's taxable income. Now, of course, as an attorney who's not your attorney, I can tell you that our tax code does provide benefits to investors. When you make money from your rental properties, when you make money from your stock dividends, there are tax breaks that you can get that are not available to people who are earning money from their jobs. If you're just earning money from your job, you're going to be subject to the highest tax rates and the least amount of tax deductions. When you're earning money from your investments or your business, now you have the potential to earn lower tax rates and higher deductions. That's the way that our tax code works. So when you're earning money from your job, you're not subject to those write-offs. You're not subject to the lower tax rates. But with your investments, you do get those things. And this is where, again now, understanding the system. Our system is designed to benefit people who understand the capitalist system. That means our system, whether it's the tax code, how much money you earn, how much assets you earn, how much freedom you have, our system is designed to benefit people who understand the capitalist system. Our system is designed to benefit people who understand how to invest and how to build businesses, period. Not everybody can be an entrepreneur. Not everybody should be an entrepreneur. But every single person in America should be a business owner. Don't go out and build a business if you're not an entrepreneur, but you can go out and invest in businesses if you're not an entrepreneur. Both of them will allow you to win in this economic system. You don't have to go out and build a business, but you can invest in other businesses. Everybody can do that, and you can start doing that with as little as $100, even $10, even $1. If you are an employee in a company, you need to become a business owner as quick as possible if you live in the United States. Now, that being said, that does not mean that you should quit your job. That does not mean that you need to go out and start a business. That does not mean that you need to go out and operate a business. But in America, in this economic system, everybody needs to be a business owner because real wealth in America is built through owning things like businesses, not just by working in businesses. Now, you're probably hearing me saying this and you're thinking, what the heck, Jaspreet, are you talking about? None of that makes any sense. Well, think of it this way. When you go out and you work as an employee in a company, you are an expense to the company. Now, I'm not saying this as like, oh, you're bad for the company. No, what I mean is financially, you are an expense. If you don't believe me, look at any cash flow profit and loss statement for a company. Every profit and loss statement for a company will show you that this is the revenue on the top. This is where the money came in from. And then you'll see the expenses. And in the expenses, you will see a line item called labor. Labor is your salary cost for the company. If you're getting a salary out of the company, you are an expense to the company, period. Now, you might be saying, but Jaspreet, employees are an asset to the company. Sure, you're right. They are. They're a vital part to growing the company. But financially, just on the numbers, we're not talking about emotions now, you are an expense. And so what you need to do is you got to take the money that you're making as an employee in the company and you need to put this to work. That way you can own some assets too. Now, the way that you do that is you take the money that you're earning and you take a piece of that and you're going to put that to work. Because guess what? Not everybody needs to be an entrepreneur. Not everybody should be an entrepreneur. Not everybody should try to operate a company. It's a lot of work and it's not for everybody and it's very overglorified. Owning and running a business is for people who have it in them and who want to do that. There's no shame in being an employee. And anybody who talks about being an employee as a bunch of crap is really a piece of crap. Anyways, there's nothing wrong with being an employee. So now what you need to do is take a piece of that money that you're making as an employee and put that to work. If you go out and take some of the money and you buy a share of a company on the stock market, you now become one of the owners of that company. If you go out and you buy one share of, say, Amazon, you become one of the owners of Amazon. Now, as one of the owners of Amazon, you don't get to tell Amazon what to do. You don't get to get involved in the day-to-day decisions, and you don't have to go out and start packaging boxes, but you get to share in the profits. The way you share in the profits is by, number one, if the stock price goes up because the company becomes more valuable, that means your stocks, your share becomes more valuable. Now, you don't actually make any money until you sell, just like how you don't actually lose any money until you sell. But if your stock goes up and you sell, that's how you make money, which is option number one. Option number two is some companies, not every company, but some companies will pay out what's called a dividend, which is a regular cash payment. They will literally just send you cash or deposit cash into your brokerage account every 3 months generally because you own a piece of this company. Now, not every company pays a dividend. The only companies that are going to pay dividends are companies that have big enough profits that they can afford just giving money to their shareholders. But that's another way that you can get paid. So now, if you are an employee, you don't own the company. You don't have any equity in the company. That's okay. But you need to be good at what you do. That way you can maintain that salary. That way you can maintain that income. And that way you can grow that income. It is your duty now to continue working there to be as good of an asset as possible. Because the better asset that you are, the more your salary is going to grow. Yeah, that means you're a bigger expense. But they want to pay for that expense because just like every other expense in the company's profit and loss statement, they have these expenses to run and grow the company. So now, if you can build yourself up as a good asset, as you can grow the income that you can make, you have more money to go out and invest. Now, a simple rule of thumb, you can find the right one for you, is to follow something like a 75-15-10 plan, which says for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. The reason why you want to do this is because now no matter how much money you're making, whether it's 25 grand a year or $2.5 million a year, you're always working to invest your money first. Now, where can you invest your money? I talked about how you can invest your money in stocks. You can also invest your money in places like real estate. You can also invest your money into other startups. There's a lot of places where you can invest your money. It doesn't really matter where you invest. but you want to be investing your money. Now, ideally, especially if you're just starting off, you want to invest your money into places that are a little bit more established, places like the stock market, places like real estate, and don't just throw your money around. I mean, you can if you start, but understand that investing is risky. You're never guaranteed to make money when you invest. And in fact, you will probably lose money at some point, but you got to get started. That way you can learn. The key is putting your money to work and own the assets. If you don't own the company where you work at, you need to own somebody else's company, period. In this American economic system, that's how wealth is built. And the great thing about this system, if you understand it, because most people don't understand it, which is why they hate the whole system, but if you understand it, you can own a piece of the system without having to work to necessarily own each individual pieces of those systems. Once you have the money, you have the tools to buy a piece of that. Now, yes, that means you're going to have to work to spend less money. Maybe that means you have to work to earn more money, but you got to take some of the money that you're earning and put it to work to own a piece of the system. That way you can actually build wealth from the system, because if you don't, then you're just constantly going to be an expense in the system and never own any assets for yourself. That's where wealth is built. You already know you're working in a company. When you're working in that company, you're working to make the company more valuable. You're working to make your boss richer. That's a fact. But if you want to make yourself richer, you got to continue doing that, continue putting in the value, continue making that increase in your income. That way now you have more money to go out and own your own assets. That way you can own a piece of the pie as well. That's how wealth is built. And this is where you got to figure out what is the right way for you to do this. Now, this is where the financial education comes into play. Like when it comes to the stock market, you don't have to go out and try to find the perfect company unless that's something you're really interested in doing. You can just invest in a piece of America. There are funds, index funds, ETFs. Both of these things will allow you to own a piece of America without having to spend all that time, effort, and energy researching individual companies. Like there are funds on the stock market, index funds, and ETFs that will allow you to own a piece of the total stock market. There are funds that will allow you to own a piece of the S&P 500, the largest 500 companies on the stock market. There are funds that will allow you to own a piece of healthcare companies. There are funds that will allow you to own a piece of real estate companies. There are funds that will allow you to own a piece of companies that are focused on just paying dividends. This way now, if you don't want to be a professional investor, you don't want to have to research individual companies, you don't want to have to try to pick the best company, you don't have to worry about your portfolio, just find the right industry or fund that you want to invest in, which is significantly less work. And now every time you get paid, just take a piece of that money and start putting it into these funds. That's where wealth is built. Now, of course, you can get started with something like a 401k, something like an IRA. These are tax-deferred retirement accounts that make the process of starting investing very simple, because lots of employers are going to offer these to their employees. They offer some tax benefits. There's some pros and cons to this, but that's just where you get started. You don't want to stop your investments just because you have a 401k or an IRA. That's just where you start. Get started with that because that's the most accessible, but then I want you to go even beyond that and continue investing yourself. Now, again, I want to remind you, investing has risks. You're never guaranteed to make money you invest. In fact, you will probably lose money at some point, and never blindly trust a random guy on YouTube, but understand that because you will have to lose money at some point because that's a part of investing. But the goal is to make way more than you lose. And the only way that you can do that is if you're willing to lose and you understand that that's a part of the process, because investing is a skill that can be learned. And patience is important. But you're never going to have that motivation to want to learn until you get some skin in the game, meaning until you put some of your own money into it and get started. And one of the most powerful assets, one of the most powerful tools, one of the most powerful values that will determine how wealthy you will become is time. The more time your money has to grow, the wealthier you will become, which means the sooner you start, the better, even if you don't have a ton of money. Listen, you don't need thousands of dollars to get started as an investor. You can get started with as little as $1 now. Thanks to the apps on the internet, you can start investing into these funds like I talked about with just $1. But you got to get started. The key is consistency. Don't just put in $1 and expect the $1 to turn you into a millionaire. You got to put in the $1 and then put in another dollar tomorrow and then another dollar the day after that. And then start putting in money regularly, weekly. Then start putting in more money as soon as you start earning more money. The quickest way to start investing more money is next time you get a pay raise, don't inflate your lifestyle. Take that pay raise and take at least a piece of that, if not all of that, and put that money into your investments. You can't show it off the way you can a Rolex. You can't show it off the way you can a Gucci belt. But if you stay consistent with it, those investments will start to grow, and that's what's going to buy you the real financial freedom. It's not getting a big pay raise, because your pay raise is really fleeting, because if your company goes bankrupt or if your leg breaks and you can't go into work, that salary disappears. But your assets will still be there. Even if you can't go into work, even if you break your leg, even if your company goes bankrupt, your assets are still there. And that's where you want to have that strong portfolio of assets that you're working to build with your salary, because that's where wealth is built. Entrepreneurs, if you are serious about building your business, then you need to be taking the money that you're making from your business and investing it back into your business, as opposed to taking that money and investing it in stocks and real estate, because none of those things are going to help build your business. But then the question is, when do you diversify? And when do you start taking some of this money and enjoying it for yourself? And the reality is, you're going to have to find where along the spectrum is right for you. Sam Walton, in his book, Made in America, the founder of Walmart, talks about this, which is very interesting. He says that when he was building Walmart, he wasn't investing his money into stocks. He wasn't investing his money in other places. He invested his money into one place. And the one place where he invested his money was Walmart. He didn't want to diversify. He put all of his eggs in one basket, which is his own company, which allowed him to grow his company. Now, did he take a risk? Absolutely. If Walmart went bankrupt, he would have lost everything. But that was what was important for him. Now, do you have to be as extreme as him? No, you don't have to build a multi-billion-dollar company, but you got to figure out where along the spectrum do you want to be. And this is where you have to figure out now, as you start to make money, when do you put it back into the business? When do you pull some money out? And when do you invest this money in other places like stocks and real estate? Because when you're building a business, there's no limit to the types of returns that you can see, right? When you put your money into the stock market, when you put your money into the real estate market, you're generally trying to get a 7 to 10% return on your money. That is the average return on stocks and real estate over the last century. So when you take your money out of your business and now you put it into stocks or real estate, now you're getting a little bit of a return, hopefully. But when you take the money and you put it back into the business, now you're not trying to get a 7 to 10% return on your money. I mean, even late stage startups are still trying to grow by 20% or more. But if you're an early stage company that has a lot of room to grow, now you could be growing by 50%, 100%, 200%, maybe even 2,000% a year in the early stages, because you take the money and you're investing it smartly back into your company. Now, there's also a risk here, because when you take the money and put it back into your company, sometimes you're going to lose. When I was investing money into my blog, because I wanted to build the Minority Mindset blog, I wanted to turn it into this self-funneling revenue stream where, okay, yeah, we can capture the Google searches, and people search these financial terms on Google, that my blog will show up, and then you're going to get all these amazing articles, and that's going to generate me money. Well, guess what? I probably put like $500,000 into that blog over the course of 18 months or so of hiring the smart people, hiring consultants and doing it. I wasn't putting my time into it, but I hired people to help take care of it, and it was a complete flop. Sometimes you're going to lose money. All the $500,000 went down the drain, and I'm never going to see that money again. Now, yeah, that sucked, and that's a risk you take. But if you keep investing back into your company and you stay consistent with it, sometimes you're also going to make smart investments which will grow into something way bigger. And that's where now you have to find what's most important for you right now. Now, if you're looking for general rules of thumb, look, if your business is not making $500,000 a year, you should not be investing your money into stocks. You should not be investing your money into real estate. Right now, your money needs to be going back into the business to learn how to grow the business, to learn how to scale the business, to learn how to sell more products, to learn how to market, to learn how to get more customers. Because right now, in that stage, you have to get more money. Once you get to $1 million and more, now you have the potential to kind of figure out where and which direction do you want to go. Because now you can have the cash flow to prove your concept. Once you're making $1 million a year, you can kind of prove that, okay, I have found something of value. And that's where then you can decide, do you want to continue building this business into something a whole lot bigger, or do you want to start taking your foot a little bit off of the gas pedal, take some of this money out for yourself, and take some of this money out to invest it into other assets that we have some diversification. And now you can also start deciding, well, how much salary are you paying yourself? And now out of the salary, how much are you going to be investing as well? Like what I do here, I'll give you just my personal example. I'm not telling you what to do. I don't recommend what I do to anybody. I'm just going to tell you what I do. When I make money in my company, meaning when I generate money from my YouTube channel or from whatever I do, my speaking gigs, I don't take that money and just put it in my personal bank account. If I go out and I charge $20,000 for a speaking gig, that $20,000 goes into the business bank account, and then I pay myself a salary out of that. I pay myself 20%. That is my commission. I pay myself, I'm on commission in my own company. I pay myself 20% of the revenue that I generate. So if I generate $20,000, that means I will pay myself $4,000. The other $16,000 stays in the business, which then goes back into the business to be reinvested. Now, when I get paid my salary, the majority of my salary is being passively invested. So I get my salary, I get a salary once a month, which is a commission off of the revenue that I get from like my YouTube ads and other things that I do. I take the salary. Now, most of this gets passively invested. Where does it get passively invested? It gets invested into places like the stock market. It gets passively invested into physical gold. Some of it gets passively invested into places like cryptocurrency. And then if I have a real estate opportunity, I will find money to do that as well, wherever that might be, because I also have my savings there as well. But the bulk of my money is being invested back into the business. Now, you might be thinking, but Jaspreet, then how do you go out and fund a big lifestyle? Well, I don't spend a lot of money. Most of the expenses that I have are write-offs. When I go and travel, these are for business purposes, meaning they come out of the business account. When I go out to eat, most of the times they're write-offs because I'm typically meeting with somebody and having a business dinner. Because guess what? A business dinner is a write-off. Me sitting by myself eating at a restaurant is not a write-off. So I want to make sure I have as many meals as possible with business people, because that then becomes a tax deduction. I don't have an expensive car. I don't have expensive purchases. I don't have fancy watches. I don't have fancy clothes. So my personal expenses are very low. And yeah, I have business expenses, but that's where now I am really focused right now on building. Right? I'm working to build Briefs Media, which is my newsletter company. That's where my focus, my time, my energy, and my money is going. I do have my passive investments, and I kind of got started in a unique way where I started by investing. I started by working to buy rental properties. That was like the name of the game for me for a decade, where I learned about real estate investing pretty much on accident. And then I did whatever I could to make money to buy rental properties. I wasn't spending money on other things. I wasn't going out and blowing money on vacations. I wasn't going out and buying nice things. I was making money from all of my entrepreneurial ventures, whether it was event planning, whether it was wholesaling real estate, whether it was selling real estate as a licensed real estate salesperson, whether it was running my other businesses. I made money and I bought as many rental properties as possible to build a real estate rental portfolio, which also pays me with cash flow. And that cash flow is things that I will spend, because this is passive cash flow, or generally passive cash flow. I still have to manage my portfolio and my managers, but generally passive. And then after doing that was when I really got more into business, learning about scalable businesses. So I kind of got into things a little bit backwards, but that was just what worked for me. So now my focus is building that active business, and this is where you have to figure out as an entrepreneur, what is the most important thing for you. Now, because I got involved with real estate early, and because I got involved in investing in the financial education side early, I love the game of putting money to work. I love the game of investing. It's fun for me. So yeah, I still do that. I'm not actively buying stocks and real estate the way that I used to. Back in the day, it was, I made money, I'm going to go out and buy a rental property. I'm going to go out and look for an apartment complex. I'm going to go out and look for stocks to buy. That was where most of my time was going. Now, it's more of, if I see a great opportunity, I will go out and take it. But most of my time is being spent taking the money, putting it back into the business, and working to grow the business. Is it risky? Absolutely. Briefs Media could go bankrupt. If it goes bankrupt, I will lose all the money that I put into the company. I will lose all the time that I put into it, and it would be a big, loss for me. But that's the risk that I'm willing to take. And now you as an entrepreneur got to find the right balance for you. There's no secret sauce to how you do this. There's no secret percentage of how you do this. Some people, Sam Walton went 100% into his company. I'm not there. You got to find where is the right percentage for you. Is it 20%, 50%, 70%? What is that right percentage? And at what point then are you okay pulling your foot off of the gas pedal? And that's where you got to figure out now, as an entrepreneur, when do you ease off of the gas, and when are you comfortable? And if you can build a business big enough, well, you could also hire somebody else to take your spot if you feel like you don't have that same drive and commitment to keep taking it further. And that's where you got to figure out now, as an entrepreneur, as a CEO, as a person running the company, where it is that you want to be and how can you scale the business the way that's going to be best for you. The work from home movement that boomed during the pandemic is really starting to come to an end now, as companies are not just asking but demanding their employees come back into the office right now. Now, of course, some companies have seen some backlash from demanding their employees to come back. Like when Amazon demanded their employees to come back, some employees held strikes at their office, some employees walked out of the office, but Amazon really didn't care. They said, okay, if you don't want to come back into the office, just never come back. You can leave. You can leave the company permanently. Same with Google. When Google demanded their employees to come back, there was some backlash over there, but Google said the same thing. We are committed to bringing people back into the office because we need people to be more productive. We found that collaboration is much better in the office, so we need people to come back. Now, naturally, there are some people that are very upset about this. People meaning people who now have to go back into the office. Some people are upset because now I can't take care of my kids like I could before. I can't spend with my time with my family like I could before. I got to spend more time in traffic. And some people are upset because, well, they're working virtually as it is. They do all their work on a computer. They do all their calls on Zoom. They just have to do it in the office. But there is benefit to being in the office, because now when you're in the office, if somebody has a question, they can come directly to your desk instead of having to just Slack you. And this is where now companies are having to make adjustments based off of what's happening in the economy. Because what we're seeing right now is obviously inflation is around. It's making people's spending ability drop, right? Because when the price of your rent and your groceries are so much higher, you have less disposable income to spend on other things. And when people have less disposable income, they have to be more cautious and careful with where they spend their money because they have less money to spend, which means certain businesses are seeing less dollars coming through their doors because less people have the ability to spend. So now businesses have to get very productive because now they are looking at their operating costs. They're looking at the revenues and they're saying our revenues are not growing like they thought. Our operating costs are growing. And now we need to make our operating costs more effective, meaning either we need more work out of each employee, we need better work out of each employee, or we need less employees. And this is where now many businesses across the board, it started off with just tech, and it was kind of funny when we started seeing layoffs in tech. This started in 2022. When the tech layoffs started happening, everybody, not here of course, but most of the traditional media kept saying that this is isolated to tech industries, that no other industry is going to struggle, that it's only tech businesses that are struggling. Today, we're starting to realize it's not just tech. Obviously, tech is one of the hardest hit, but it's not just the tech industry. But now what we're seeing is businesses across the board are saying we have to make these adjustments, and they're asking employees to come back into the office because now each company is needing more productivity out of their employees, because what they're finding is the productivity when people work from home is generally less. Is that 100% of the time? No. There are some people that are more productive working from home, but the majority of people statistically are less productive when they work from home. So now companies who are looking at their financials are saying, we have to turn things around. Otherwise, we're going to be out of business in 18 months or 24 months or 36 months or whatever it might be. And so now they're saying we got to get people to be more productive. We need more work out of each employee. And that's where now employees are saying, either, okay, I get that. I'm doing whatever it takes to grow the company. I'm going to come back to work. Or they're saying, I don't want to do that. And it's a real shift in dynamic because now what's happening is the economy is slowing down, which means the job opportunities out there are also starting to shrink. And so companies are saying, okay, if you don't want to come back into the office, just never come back. That's okay. They're looking to reduce their staff size anyway. So if you want to leave voluntarily, it makes the job even easier for the company. So if you don't want to go back into the office, find a different company that will hire you. Companies are embracing that now because they need less operating costs and they need more productivity out of each person, because now when you enter a time where the economy is slowing, that means revenues are falling. Companies have to get more productive. They have to get more profit out of the business, because when times are good, money is growing, growth is there, you can do whatever you want. The reasonableness as to what an employee can do is really whatever, because the company is making money. But when you start to see that shift, well, that's when the companies demand more. And over the last number of years, the power was really held in the hands of the employee. We did a full deep dive on this in Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so, because it's an easy and free way for you to stay up to date on what's happening, when it's happening, that way you don't get blindsided by the economy. And if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. But this is where now the shift is happening, where 2020, 2021, and even into 2022, the power was in the hands of the employee. Employees were pretty much in full control. Now we're starting to see that dynamic shift. It has not completely shifted yet. We're still seeing a lot of power in the hands of employees today, period. That is 100% true, because there's still today way more job openings than there are employees, period. And I'll talk about why in just a second. So employees still have a lot of power, but we're starting to see more and more of that dynamic shift. And if the economy continues to go in this downward direction, if we continue to see high inflation, you're going to see this shift happen even more aggressively, where the power will shift then to the hands of the employer. And the reason now why we're seeing this shift is just naturally because of, well, the whole changing tides in the economy. The Federal Reserve Bank is working now to bring down inflation by raising interest rates. These higher interest rates mean that it's more expensive to borrow money. And if you're a business, your debt costs have risen, because businesses don't have 30-year fixed rate mortgages. They have adjustable rate mortgages. And so now when you have a lot of debt on your balance sheet, you have a lot of debt on your books as a business, this debt is going to readjust at a higher interest rate, which means your costs go up, in addition to the inflation making your costs go up. So now as a business, you have higher costs, and revenues are not growing because the economy is slowing. And so now you're having to make these decisions. And the reason why businesses are really struggling is because of how fast businesses boomed in the last number of years. See, in 2020, 2021, and even in 2022, there was a ton of free money. And we saw this in stimulus checks and unemployment checks, but it wasn't just for people. Businesses were also getting tons of free handouts from the government. They were getting free loans. They were getting free grants. There's a lot of free money going to businesses. And so now when you're a business and you get all this free money, what are you going to do? You're going to want to expand. You're going to want to grow. You're going to open new industries. You're going to open new operations. You're going to hire more people. You're going to open more stores. You're going to open more manufacturing plants. And this created a huge boom, which also resulted in way more job openings because businesses had the ability to hire. But now that is changing. We haven't seen the full effect of the higher interest rates yet, but we're starting to see this change, where now that free money is going away and businesses are now having to make profit of all the growth that they had. And a lot of businesses are now saying, we don't have the capacity to manage all this growth, all this hiring that we did in the last few years. So now we need to downsize. And that is starting to shift the tides. Now, this is where a lot of people have opinions as to how much the tides will shift. Some people are saying it's just going to be a mild pullback. Some people think it's going to be a lot more severe. Some people say there's going to be no pullback. But this is what's happening right now. The higher interest rates are shifting the tides in the economy. There's no more free money like there was before. The grants are starting to go away. Debt costs are starting to rise. We're going to see more and more debt costs rise over the next 12 to 24 months. But that's where now we're going to see a real shift. And along with that is going to be the shift in the power of the workplace. In the last 3 years, it's been in the hands of the employee. Now we're starting to see that start to shift. It hasn't completely happened yet, but we're going to see more and more of that shift as the economy continues to hurt. If the economy continues to hurt, if we continue to see this slowdown in the economy, there's going to be a bigger shift. And that's going to cause a lot of changes in the workforce. And if people don't want to go back into the office and they're not willing to work, well, you can do that when you have other job opportunities. If you have another place where you can work from home, great. If you have another job opportunity, or if you have savings or you have investments that you can fall back on, great. You have the money and the wealth to do that. You have that power to do that. But when that other opportunity goes away, or when you don't have the money to fall back on, that's when you'll start to really see that shift. So what does this mean now? Well, if you're an employer, you better get serious with your business and your operations and make sure you're running lean, make sure you don't have a bunch of operational costs, and make sure your productivity is still high. Period. You don't have any other option. If you're an employee, understand the shifting tide. This is going to be happening over the next 12 to 36 months. You're going to see a lot of shifts in this. And you can hate it. You can hate me for telling you this. Look, I'm not here to make friends. I'm just here to help you be better with your money. I'm just telling you what's going on. But in the next 12 to 36 months, we're going to see more and more shifts with this happen. So if you are an employee, understand that this shift is happening on the employer side. And if you need the job that you're in right now, the common trend right now is if somebody doesn't want to come back into the office, you're going to be the first one to go. Period. And so understanding that and figuring out what type of lifestyle you want, what type of job you want, and what type of career you want, and if the job that you're at right now is going to provide that. So just be honest with what's happening, understand it, and then make a decision based off of that, and understand that, the work from home culture is changing. And if you want the ability to be hybrid, you're going to have to now prove it even more. And you might say, but Jaspreet, I'm already working hard. I'm doing this, I'm doing that, and I don't want to work hard. Look, if you want your company to let you work from home a couple of days a week, you're going to have to prove it, because in the business's perspective, productivity is going to become essential for each employee. And if you cannot show that, they're not going to be able to approve it. This is the situation that we're in right now, and that's why I want you to understand this. That way you can be proactive and take the best care of yourself. That way you have the ability to take care of yourself, your family, and your community, right? Because if your company's struggling, they're going to make certain decisions. And you want to know what factors and criteria they're going to be looking at when they make these decisions prior to that decision being made. That way you can make sure that you are protecting yourself. Now, does this guarantee you're going to protect yourself? No. But these are the factors that companies are looking at. An employees' productivity and ability to come into the office are now crucial. Google talked about this. The CEO of Google said that in the coming productivity meetings with employees, one of the things they're going to look at is how many times the employee signed into the office with their badge. These are going to be things that are discussed in their quarterly or monthly meetings with their superiors. So yes, tides are changing. It's not just tech. It's going to be happening in other industries. So understand this. Know what's going on with your company. Obviously, every company is different. Every person is different. But understand what's going on. That way you don't get blindsided by what's happening, and you can be proactive and take the best care of yourself, your family, and your community. I think a big reason why people are really searching for new ways to generate quote-unquote passive income is because the cost of living has grown so significantly relative to wages. Take a look at these numbers. Between 1970 and now, wages have increased by around 640%. Over that same time, housing costs have gone up by around 1,100%. Car prices have gone up around 1,500%, and public university prices have gone up by around 1,900%. When you see these numbers, naturally you can understand why people need more money to survive. You hear stories of your parents and your grandparents talking about how, back in my time, I used to work a job. My wife didn't have to work, and I had enough money to fund my lifestyle. Well, today, that system doesn't work. Now you have two-income households, and people are still struggling to survive because households' incomes have risen, but they haven't risen fast enough to keep up with the cost of living. And notice that when I showed you these numbers on the screen, I said household incomes, not your average wages. Household incomes are looking at both parties who are potentially earning an income. And back in the 1970s, it was one income generating the household income. Today, it's two incomes generating the household income, and people are still struggling to survive. And this is where it has become so crucial to understand how you can earn more money, because the reality is, if you want to continue living a decent lifestyle today, it has become so important to learn how to earn more money. And this is where, the argument everyone's making is, my boss needs to pay me more. Well, if they're not, you can ask for more money, but if they don't give it, you also need to find an alternative. Complaining, crying, kicking, screaming is not going to fix it, and this is where you have to understand the reality of what's going on in the economy. Now, I've talked about what has caused this. The cause of this is the inflation, because in the early 1970s, we had our dollar stripped from the gold standard, meaning the dollar was no longer tied to gold. The government could spend whatever amounts of money it wanted. The Federal Reserve Bank, which is a central bank here in the United States, could print an unlimited amount of money, which meant that the value of our dollar started to drop, causing the price of things to go up. When we started to see that happen, well, naturally the prices of things rose, and that's what then caused the inflation that we've been seeing over the last number of decades, and especially the last few years. All the money printing has devalued our currency, causing the price of things to go up, making it more difficult for people to survive off of one income and now even two incomes, which means if we fast forward now 10, 20, 30 years, what is it going to be? Is it going to be enough for people to survive off of one income like it was in the 1970s? Is it going to be the same like it is today where people need two incomes to survive? Or will it be four income households, as in two people need two jobs each in order to survive? Now you can guess and pick whichever it might be, but this is what I'm trying to get you to understand is, well, instead of trying to hope that things are going to go back to how it was in the 1970s, understand the trend. Inflation has made the cost of living rise faster than wages. Period. The cause of this is all the money printing because of the Federal Reserve Bank and the spending by the government. Unless the government stops spending so much money, which doesn't look like it's going to happen, and unless the Federal Reserve Bank says we're not going to keep printing any more money, which doesn't look like it's going to happen, we're going to continue seeing what we've been seeing over the last 50 years. So now as you project out for the later parts of your career, what's going to happen? Well, if the cost of living keeps rising, you are going to need more income. And which means you want to start preparing for this today. And I know this is not something that most people want to hear, but I'd rather you learn this sooner rather than later. That way you can prepare and take better care of your family. Right? My goal here isn't to make friends. My goal here is to help you be better with your money. That way you can make more wealth for yourself, your family, and your community. And this is where understanding this inflation problem is not going away. Even if inflation goes back down to 2%, it's still there. And that means the cost of living is going to keep rising. And, well, if your wages are not keeping up, you're going to see the value of your earnings, the buying power of earnings continue to drop, and the buying power of your savings continue to drop while the prices of things keep rising. So now, how do you earn more money? Well, there's a lot of ways you can do this. And thankfully, today, there are more opportunities than ever before. And this requires, number one, your interest, and number two, your work ethic, because it is going to require more time on your part. Now, if you want to do it from a job, you can try to find ways to earn more money from your job. Maybe you work for a raise, you work for a promotion, maybe you work to get some more hours, maybe you work to do more at your job, that way you can earn more money. Maybe you work to get a second job, that way now you can really work to earn more money today. And you don't have to do this permanently for the rest of your life, because I call it the decade of sacrifice. The way that you build wealth is by owning assets, period. It's not by saving a lot of money, because your savings are losing value to inflation, and as soon as you start spending your savings, the savings amount decreases. It's not through your salary, because if you break your leg and you can't go to work, well, you no longer get a salary. The way that you build wealth is by owning investments, because these investments can continue to pay you even when you're not working. And as you see more inflation, that generally benefits investments. Now, if you see a recession, of course, investment values can go down, but that also creates good buying opportunities to own and buy more investments. So now, how do you get more investments? Well, you got to spend less, or you got to earn more, or both, that we have more money to own these investments. And right now, if you're seeing what's going on with the cost of living, well, people need more money to survive. Now, how do you build your own wealth? Because you can't just spend all of your money and not put money away to build your wealth, even if the cost of things are rising, right? People are looking at what's happening right now. They're saying, oh my God, if student loans have to start again and I have to pay more money to my student loans, I'm not going to be able to invest my money anymore. You cannot make that sacrifice. You still have to continue building your wealth no matter what's happening in the outside world, which means you're going to have to figure out either A, how do you spend less money, or B, how do you earn more money, or C, how do you spend less and earn more money, that way you have more money to invest, period. If you want to build wealth, you will have to do that, because nobody else is going to do it for you. I hate to break it to you, but Social Security is not going to be enough for you to retire. And your 401k is not enough for you to retire. Even the founder of the 401k has come up publicly and said that the 401k has gone awry because so many people are relying solely on the 401k to retire, and it was never intended to be your sole retirement plan, which means you're going to have to invest more money, period. That is your way out. You got to spend less. You got to stop playing the spending game of financing the brand new car. You got to stop playing the spending game of constantly having the new Gucci. You got to stop playing the spending game of having the nice stuff right now. So you have more money to invest, and also work to earn more money. That way you can go out and invest more aggressively. So now, how do you earn more money? Back to the original question, because if things continue to go down the path that we've been seeing happen the last number of decades, how can you access more money? Well, we talked about how to do it from a job. If it's not from a job, look for ways to earn money outside of a job. And the internet has made this so much more accessible. Not easier, but accessible than ever before. Because now on the internet, the name of the game is attention. If you can grasp somebody's attention on the internet, maybe it's with a blog that you write, maybe it's with a newsletter that you create, maybe it's with your Instagram page, maybe it's with a TikTok page, maybe it's with a podcast that you start, maybe it's with a YouTube channel, maybe it's with something else. If you can grasp somebody's attention on the internet, you can then make money on the internet. Attention is the new currency on the internet, and the way you get paid now is by monetizing the attention. Now, the simplest way to monetize the attention is with advertisements, right? If you have videos on YouTube, you have a podcast out there, you're going to be able to have advertisements on your content and you can generate money. If it's not through advertisements, you can also sell somebody else's products so you don't have to build your own business. This is called affiliates, where other businesses will pay you for promoting their stuff. Or you can build your own product. You can sell your own service. Maybe you have a service. You have a bookkeeping service that you can offer. You have an accounting service. You can do digital marketing for somebody. You can do graphic design for somebody. You can do writing for somebody. You can do the legal work for somebody. You can do some sort of health consulting for somebody. If you have a service, you can offer that now to people who are watching, listening to, or reading your stuff. Because when you have somebody's attention, you can offer your product. You see me doing this all the time. I have a company called Briefs Media. One of the products that we have in Briefs Media is Market Briefs. Market Briefs is my free financial newsletter, where it's a way for me to keep regular investors up to date on what's happening in the financial news. It goes out 6 days a week. We have a team that's breaking down what's happening, things in the housing market, the stock market, the crypto market, the global economy, and our own economy into this fun, witty, and easy to read email. And it's completely free to you. And the way that we monetize Market Briefs is we sell advertisements in Market Briefs. This allows us to keep the newsletter free, but I have this attention on the internet. People watch my videos, and then I'm able to market and get promotion and exposure for Market Briefs. Now, if you want to join Market Briefs, you can go to briefs.co/marketbriefs. That's briefs.co/marketbriefs. And I also got the link for you down in the description below. But this is where now the question is, once you grasp somebody's attention, how do you monetize? And that's the easy part. You do not have to know how you're going to monetize when you start, but you have to get started, because the reality is things are not going to go back to how they were in the early 1970s. Things are going to continue going down this direction. Things are going to continue getting more expensive. Sure, we might see periods of deflation. That's what happens sometimes when you see recessions. But then after that recession is over, the deflationary period ends and you see inflation kick back up. So you have to understand that if we continue to see the housing costs rise, if we continue to see the price of cars rise, if we continue to see the price of phones rise, if we continue to see the price of groceries rise, what are you going to do? How are you going to earn more money? And it's better for you to ask yourself this question sooner rather than later, because it gives you more time to work towards it. It gives you more time to ask that question of what are you going to do and think about it. And this is why I keep saying that the best investment that you can make right now is by canceling your Netflix subscription. Not so you can save $15 a month, but so you can save 2 to 3 hours of your time every single day. That way you can reallocate this time to, number one, learning about how you can earn more money. There's tons of videos on YouTube. There's tons of blogs on the internet. There's tons of people on the internet teaching this for free. And then you spend your time doing. Try things. That is the best education. Then, of course, once you start doing things, invest in your own education. Buy classes, buy coaching, buy that stuff, because it will teach you lessons. Just don't get into all the gimmicky, hypey stuff. Learn lessons from people that are actually doing what they teach, but invest in yourself. And number one, it starts by learning. Then you got to do, then you got to fail, then you got to keep learning and doing more. That's how you will learn. but you have to get started. Listen, I had no idea that I was going to have a YouTube channel that has over 1 million subscribers on it. That was never my intention or my thought when I first got started, but I stayed consistent with my content year after year after year. I've been on YouTube for a long time. Look at my early videos. My videos sucked, but I learned and I improved. And that's what allowed me to build this platform, this minority mindset platform, which then became a funnel for businesses like Briefs Media. So this is where now, if you want to be able to earn more money, you can't just copy what anybody else does because it's too late for that. But you can learn and apply, because the reality is you're going to need more money to, number one, fund your lifestyle, and then number two, to continue to be able to invest and build your wealth, because the last thing that you want to see happen is then you start sacrificing your opportunity to become wealthy because you just want to keep funding your lifestyle. Do not let that happen. We're seeing that happen everywhere. Use this as an opportunity to start learning, to start earning. That way you can continue building your wealth, because that wealth is what's going to give you the opportunity to fund your family the way that you want. It's going to give you the ability to help your community the way that you want. And it's going to give you that financial freedom to fund your lifestyle the way that you want. Most people don't want to believe this, but you don't need to make a lot of money to become a millionaire. If you can invest $4 a day, or even just $100 a month, that's less than $4 a day, you can become a millionaire. Numbers have showed us this from history. If you can invest $100 a month, that's less than $4 a day, and you can get an average 10% return on your money a year, and you do this for 46 years, you will retire a millionaire, which means if you start at age 21 and you start investing $100 a month and you never invest another penny besides the $100 a month, you will retire a millionaire. Now, the first question you're going to ask is, but Jaspreet, where am I going to get a consistent 10% return? Well, if we look at history, the S&P 500, which is the largest 500 companies in the stock market, have on average over the last century grown by around 10% a year. Even though we've seen recession after recession after recession, even though we've seen market crash after market crash after market crash, on average, even despite all these downturns in the economy and the market, the S&P 500 has still grown on average by 10% a year over the last 50 years, over the last 100 years. Now, you don't have to go and invest individually into each one of these companies. There are funds that will allow you to invest into something like the S&P 500. Again, the S&P 500 is a group of the 500 largest companies on the stock market. If you go to your stock brokerage, I'm not telling you what to invest in, I'm just giving you an example. Always do your own due diligence. Never trust a random guy on YouTube. Investing has risks. You understand all that. If you went to your stock brokerage and you bought shares of SPY or VOO, as a disclaimer, I own shares of VOO. Both of these are ETFs that give you exposure to the S&P 500. So now, if you were buying the S&P 500, $100 a month, from the day you turned 21 to the day you turned 66, you would have retired a millionaire on that $100 a month. Now, of course, yeah, this is looking back in time, but that's what would have happened if you made those small incremental investments, which is why it's so important to get started, even if you don't have a ton of money to start, because most people have the ability to put aside $4 a day. Now, your next question is going to be, but Jaspreet, by the time I'm 66 years old, $1 million is going to be nothing. And sure, $1 million today is going to be worth more than $1 million in 30 years or $1 million in 20 years. You're 100% correct. But you also have to remember, I'm talking about investing $4 a day and never adjusting how much money you invest. If you start with $4 a day today, $100 a month today, and then as your income grows, you also start investing more money. Let's say you start investing $100 a month today. Next year, you invest $105 a month. The year after that, $110 a month. The year after that, $120 a month. Guess what? You're not going to have $1 million when you retire. You're going to have more than $1 million. So yeah, the value of $1 million is going to adjust with inflation as time goes on, because inflation is still here. Inflation is going to be around today and 10 years from now and 20 years from now and 30 years from now. But you can also work to match that by also increasing how much money you invest. So now the question is, well, what's holding so many people back? And this is where we have, well, a lot of things happening. Number one, it is no longer access to technology, right? I mean, we have so many tools now in our tool belt, that allow people to start investing their money very simply. That's the great part. I love that part about fintech is that investing has become so accessible for the average person, for anybody, that anybody can start investing with as little as even $1 now with some apps. The downfall now, the double-edged sword to this is people have access to this financial technology to start investing, but the financial education is lacking. And this is where now people get caught up in the wait. You're telling me that if I invest $100 a month for 46 years, I'll become wealthy. But if I put $100 into this meme stock or into this cryptocurrency or into this particular thing that's going to boom in 6 months, I could 10x my money way faster and I don't got to wait to become wealthy over the long term. Now we have the exciting and the attractive and the fun side of investing, which really isn't investing. It's trading, it's gambling, it's speculating. Look, there is a place for trading. It's not for me. I don't trade. I don't know how to trade. I've tried trading before. I spent a lot of time trying to figure that out, and I didn't make any money. In fact, I don't even know if I lost money, but I probably lost a little bit of money doing that, but I lost a whole lot of time. Over the long term, what we have seen again and 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 again are the investors, the long-term investors are the people that will make more money over the long term, period, over traders. When times are good, the economy is booming, money is flowing, interest rates are low, everything's going up, traders will make a lot of money. We've seen that happen. And then that's when people get attracted to, wow, this person made so much money on this trade. Wow, I can't believe how fast you made that much money. Wow. Do you think I should come in too? Do you think I can make the type of money too? And that's what gets a lot of people excited to start throwing their money into things that they don't understand, whether it's cryptocurrency, whether it's meme stocks, whether it's other stocks, whether it's penny stocks, whether it's anything. People will start throwing their money into things before they understand them. Because you think, what if I can also see those big returns? But the reality is, those returns are fleeting. If you get in quick enough and you sell before it busts, yeah, you can make a lot of money. But it's a game, and this is an active game, and it's a game that many people, most people, will lose money in. And that's where now you have to understand the right way to do it yourself. Now, you might be saying, but Jaspreet, don't you invest in cryptocurrency? Yeah, but I'm not trading. I understand a different way of investing, right? I buy cryptocurrency every day, and it's a small piece of my portfolio. It's the speculative part of my portfolio. And so for me, I don't look at buying my investments like a trade. I'm looking at things 10 years down the road and what this will be worth to me then. And I don't advocate anybody to do what I do. I want you to take your own education and invest in what's important to you. So now, if you can become a millionaire with as little as $100 a month, and you can make even more money if you invest more money, next question is, well, what's stopping people? So it's not the technology. Now we talked about the financial education. The last thing is, well, do I really want to wait that long? And now we get into this whole investment overload, this education overload. And it's the same with so many industries, right? The good part about social media is now people, you have access to unlimited education for free. You can go and learn about how to lose weight. You can go and learn about nutrition. You can go and learn about money. But there are so many opinions. In the health and fitness space, there are so many opinions about what's the best diet. Is it vegan? Is it carnivore? Is it keto? Is it whatever, intermittent fasting, whatever the other diets are? There's so many options. And so if you're just getting started and you start learning about all these options, you can very quickly be overloaded with it and say, you know what? I'm just going to stick with my donuts and cream cheese and I'm going to be good with that. We see it happen all the time with money, where people start looking at all their options. Okay, I got ETFs. That looks cool. Oh, index funds. Oh, what about mutual funds? Oh, real estate. Syndicate real estate deals, crowdfunded real estate deals, private equity deals, lending money. Oh, and now all of a sudden you get bombarded with all this information. And then you have a lot of people saying, you have to invest in this one thing. This is how you build wealth. When most of the times when people are telling you have to invest in stocks, or you have to invest in real estate, or you have to invest in options, most of them have their own agenda as to why they think there's nothing else out there. In reality, you can invest in whatever it is that you want, assuming it's a good investment, right? You can invest in stocks and build wealth. You can invest in real estate and build wealth. But you have to find the right option for you. And the mistake that so many people make, and the reason why so many people don't become wealthy from their investments, isn't because they made the wrong investment. It isn't because they invested into something with the wrong expense ratio. It's because they never got started. There are 3 factors that will determine how wealthy you will become for your investments. It is number 1, time. How long do you invest your money for? Number 2, dollars. How much money are you investing? And number 3, return. What is the return that you can get on your money? You can work to improve the return, and you can work to improve the dollars. The one thing that you cannot change is time. We cannot go back in time and start investing 10 years ago, but we can get started today. That is the one factor that we cannot change. And that's why it is so important to just get started. You don't have to make a commitment, a life commitment today with your investing strategy. You can start investing in ETFs today and then 6 months later say, you know what, I'm going to invest in index funds, or I'm going to invest in mutual funds, or I'm going to invest in real estate. That's okay. You will change because you're going to learn. You're not going to know everything going into it, but you have to get started. Time is the only factor that you cannot change. You can change how many dollars you invest, because what happens to a lot of people is you start investing and you get into this whole game of, oh, wow, I'm starting to understand this. I'm starting to see that light at the end of the tunnel. I'm starting to see what it would be like to compound my money. You start playing with those compound interest calculators online, and you start to see what it would be like for your money to compound. And that's when you say, I need more money to invest because I want to put some fuel on this fire. And that's a great feeling when you get there. The first thing that a lot of people do when they get there is you stop eating out. You stop going on vacations. You stop spending money. And, that's something I think most people need to do in the beginning, that way you know how to live below your means, you know how to make those sacrifices. But then the next thing is, how do you work to earn more money? And the reason why you're working to earn more money now isn't so you can drive a faster car or a bigger home like most people are doing. It's so you can invest more money. So yeah, you can change how many dollars you invest, which will impact how wealthy you become, because the more money you invest, the wealthier you can become. But then the third factor you have to also work on is the return. How can you get the highest return? Now, the way you can get the best return is, number 1, you start building that financial education. You learn how to make better investments. You learn how to, make better things, make better decisions with your money, that we can get a better return, but also pay less money in fees. That way, more of that return goes in your pocket. So you can work on the return side. You can work on how much money you invest, but you cannot change how much time you have, which is why you have to get started sooner rather than later, because the longer your money has to compound and grow, the bigger your wealth will be. And the most difficult part about this is that concept of delayed gratification, because again, in today's society, when we want something, we want it today. When we want a luxury handbag, we want it today. You buy it with 0% APR. You buy it with a no interest credit card. You buy it with buy now, pay later. It is so accessible to have whatever we want right now, and that is what got a lot of people into the tough financial places that they are today, because we want convenience. Amazon was built on the whole concept of convenience, where now I don't have to go to the store to buy something. I can buy it online. Now, don't get me wrong. I love shopping on Amazon. I barely go into the store. I don't like going into stores to shop because it's a waste of my time. I love this idea of convenience. But the whole model was built on convenience. And now it's one-click purchase. You want to buy a new laptop? You can buy it with one click. You want to buy a new microphone? Buy it with one click. Getting whatever you wanted has become so convenient. And then came, okay, you want to buy a laptop you can't afford? No worries. You don't have to afford the laptop. You can buy it, pay it later. You can pay it in installments. And this is where now the convenience is starting to impact people's finances, because now we're saying, all right, you can go and spend whatever it is that you want. Just worry about the price later. And there's a reason why buy now, pay later, 0% APR are so profitable, right? Buy now, pay later, as I like to call it, broke now, broke later, is one of the fastest growing fintech industries out there. Why? Because there's such a big demand for it. Why is there such a big demand? Well, number 1, inflation is still extremely high and the cost of living has gone up so quickly. And then number 2, people love having things now. We want to have things today, and that has caused the boom of things like buy now, pay later. But now let's think about this for a second, because the whole idea is, or the marketing pitch is, 0% APR. You don't got to pay any interest for this. And so what a lot of people think is, I found a special loophole that I can have more stuff today. It doesn't have to cost me anything because there's no interest, and I get to have all the nice things. So I found this little loophole in finance. But let's think about this for a second. There's a cost to money. There's a cost to borrowing money. Because, if borrowing money was free, banks would not charge you interest to get a mortgage. So if businesses or these buy now, pay later apps are giving you money for free with buy now, pay later or 0% APR, how are they making money? Well, they are making money. In fact, it is extremely profitable. So how? Well, the first thing is they know that if they can sell you a computer on buy now, pay later, you might also buy a mic with buy now, pay later, because you don't have the pain of paying, $3,000 for these laptops now. So now you might buy a mic to go with it. Maybe you'll also buy a camera to go with it. Maybe you'll also buy a handbag to go with it, because now you can buy all these things on buy now, pay later, and instead of paying that $3,000 up front, you can just pay $100 a month for each thing. You don't have the same pain of that money leaving you, so you're going to end up buying more stuff. So the first thing is buy now, pay later encourages people, and statistics show this, the majority of people will buy more stuff. Number two, it's okay, so now I start buying all these things, and then I have all these monthly payments. If I don't pay it off in the 9 months or 18 months that's given to me, I'm now going to be slapped, not with a 5% interest rate, but with a 28 or a 35, maybe even a 39% interest rate. And so now all of a sudden, buy now, pay later went from this, it's a special loophole that allows me to have more stuff without paying more money, to I am paying so much extra to buy all the things that I didn't know that I didn't need, that I couldn't even afford in the first place. That's why these programs are so profitable. And this is where now you have to make that decision. What do you want first? Do you want the nice things, or do you want the wealth? And if you're watching this video, I know what it is that you want. You want that wealth first. So you have to switch the way that you think, because the reality is the majority of people will never understand this, right? We're raised in this consumerism culture, and it's very unfortunate. And if you want to break out of that, the first thing you got to do is you got to change your mindset as to what it is that you want and when you want it. Now, when you can change your mindset on the way you spend, you can change your mindset on the way that you invest, because it goes hand in hand. It is your brain strings work the same way when it comes to long-term thinking. If you want to have all the nice stuff now, what makes you think that you're going to be able to invest for the long term and build your wealth that way? If you want all the nice stuff now, you're going to want to invest your money and grow it the same way. And what ends up happening is when you want the quick returns in your money, well, you're probably going to be the one that loses your money and pays for somebody else's long-term gains. And so now you lose both ways. And then you start hating the investing game. You start hating the system. You hate Wall Street. You hate corporations. You hate banks. And you just get into this whole system of just working to pay your bills and never wondering why you can never get ahead. But it starts with your mindset now. If you want to break out of this system and really build true wealth for yourself and your family and your community, and build true generational wealth, it starts with your mindset. Where now, okay, when I spend my money, I'm going to spend what I can afford, meaning money that's coming out of my pocket with cash, not going into debt to buy these things. Now you understand, okay, yeah, maybe I can't buy the nice laptop today. Maybe I can't buy the nice stuff today. I got to downsize because I want to be able to afford it with cash, especially when it's liabilities, something that's not making me any money. You got to make sure you're not buying things that you cannot afford. The simplest thing you can do is follow something like my rule of 5, which says if you can't buy 5 of them, you can't afford 1 of them. Then you reframed your spending. Now you're going to start reframing the way you invest. Now you're going to understand, okay, we're working the long game here. We're working to build that wealth now. Okay, I can build wealth. I can become a millionaire with $100 a month if I have enough time. I need to just get started. And this is where now you start investing. And again, there are so many ways to invest, but you got to just get started. Start doing your research, start reading books, but also get started by putting your money aside to start investing. Then as you do that, that's when you start learning. And as you start to learn, maybe you'll change your investing strategies. Maybe you'll say, I want to invest in stocks instead. Maybe I want to invest in individual companies instead. You will start to learn, but you have to start building that discipline, because now investing is a long-term game. The people that build the most wealth are not the people that hit something quick, that hit the lottery in the stock market. It's people that are working to build long-term wealth. There's a saying, this about Warren Buffett, who says, when the tide goes out, you see who's been swimming naked. And what that means is that when the free money, when the economic boom goes away, you see who's been living this fantasy lifestyle where they've been living high off of the economic boom. But then when you see that money and that whole system start to slow down, those people are the first ones to lose everything. And it can be very easy to fall into that trap because it's a very emotional thing. Oh my God, yeah, why would I want to wait to get rich when I can get rich now? I mean, get rich slowly is not a very attractive term. If you had the option to get rich quick or get rich slowly, 100 out of 100 people would pick get rich quick. But the reality is most people don't. The vast majority of people will never get rich quick. It's get rich slowly. Yet we get attracted to the get rich quick because our emotions go this way if our mindset is not wired to understand that this get rich quick is probably going to fail. We look at the opportunity, but we never look at the risk on the get rich quick. But what's interesting is when we look at the get rich slowly, now, instead of looking at the opportunity, we're looking at the risk. The risk is, man, that's a long time from now. What if it doesn't work out? What if $1 million in 40 years isn't worth as much as it is today? So instead, we take all the riskier options with a much lower potential to actually succeed. Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things. You want to start spending money. You want to start going on vacation. You want to start buying a nice apartment. You want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money.